It's Jonathan Levin with Bloomberg Opinion, and I'm here with two great economists to dissect the numbers as they come in. We have my colleague Allison Schrager. She's a senior fellow at the Manhattan Institute and the author of An Economist Walks into a Brothel, as well as, for the first time, Guy Berger. He's over at Burning Glass Institute, directing research over there, previously of LinkedIn, where we first had the opportunity to speak. Welcome, Guy. Welcome, Allison. How you guys doing?
Great.
Good to be here.
Good. All right. So here's the deal. Coming down the pike in about 4 minutes, we're going to get the numbers on non-farm payrolls. The Bloomberg survey, the median estimate says it's going to come in at 214,000, which would be down from the, shall we say hot, shall we say warm 275,000 the previous month. There are still a lot of questions in this data. People say, do I trust the establishment survey? Do I trust the household survey? What does it mean for monetary policy going forward? So we're going to try and dig into that as it hits. But Guy, let me kick it over to you for a little preview. What are the stakes here in this data drop?
Well, it's funny. I think what we heard from Chair Powell is the labor market data, as long as it sort of remains within certain norms, almost doesn't matter. The Fed doesn't want to have a recession. I mean, they do want to see wage growth, continue maybe to cool a little bit, but it's in the zone where they're reasonably comfortable with it. And it's really just, in some sense, this today, despite all the energy we're going to expend, is almost a sideshow to the inflation data we're going to get in a few weeks, which is really what the Fed is just staring at month after month to see, is this going to get to the point where we can cut rates or not?
Yeah, for sure. And yet, of course, so you mentioned the Fed. The Fed is a consensus building institution, right? And I think Powell certainly alluded to what you're saying. I think you hear sort of the same thing from an Austin Goolsbee, but maybe if you look towards the more hawkish side, maybe a Neil Kashkari, they're looking at it and they're saying, my goodness, we're adding 275,000 jobs a month. Maybe we're not actually that restrictive. What do you make of that take, Allison?
I'm feeling more sympathetic to it. I mean, or at the very least, it doesn't seem like this is an environment where inflation is going to continue to come down. I mean, as I said, we'll see, but as long we're having a lot of real wage growth, and we don't have a lot of deflationary pressures left. So it does seem like this is a pretty good economy. I think the Fed just has to come to terms with the fact that this is where inflation is, or we're going to have to actually damage this economy. And things are pretty good right now. So, I think it's going to be interesting where we are, but this is sort of, it's a healthy economy, and it seems almost impervious to sort of Fed rates, as well as just reading something about how, a lot of, companies are not even refinancing at these rates. So it doesn't seem to be doing much damage to them.
So what are we potentially going to learn in about a minute and a half that's going to help us make sense of the world? Guy, what are you most attuned to here coming out?
I guess what I'm most interested in, there was a thing coming, it's really, I think I was a little premature about it last spring, but I thought, well, with chance of a soft landing coming in and the Fed at the very least not tightening further, do we start seeing this data that definitely did cool in 2022 and the beginning of 2023? Will it stop cooling? And some indicators, non-farm payrolls, they stopped, the gain rate stopped falling in last spring, and then other things have cooled. And I think the question I keep coming back to is, at what point do we reach, barring more Fed tightening, a steady state? And I keep staring at the numbers every month and changing my mind. We're almost there. We're not there, but that's what I'm looking at.
Okay. What about you, Allison? What are you most focused on here? I'll stop you if the numbers come out.
I guess again, like wage growth, because I think that will give us some insight into where inflation is going, and also just the health of the consumer.
Right. But even there are a lot of questions, right? You have the productivity bulls out there who say, maybe we could live with an economy where wages are growing more than 4% per annum. Would that really be such a terrible thing? We should be getting the number any second. So
Ooh.
there you go. Whoa. So you get a 303,000 jobs created on American payrolls, according to the number that's populating right now, including 232 from the private sector, some meaningful job creation from the government. The unemployment rate stays flat at 3.8%. The average hourly earnings doesn't do. I'm sorry, the unemployment rate dips down to 3.8%, but matching expectations. And average hourly earnings also matches expectations at 4.1%. So what do we make of this? We're going to have to dig into this a little bit because this is another head scratcher. But off the bat, extremely strong number. Average hourly earnings actually ticked down a little bit. I don't know, Allison, Goldilocks? What do you think?
Yeah, I mean, I think we might be hitting guys steady state of it seems like, high threes is, our natural rate of unemployment. And, said this is good wage growth, which, isn't necessarily bad. I mean, like, we don't see inflation accelerating. We just probably won't see it coming down. So I'm starting to think like maybe we should just, people are going to start to argue that maybe we should just live with a, 2.5-3% inflation rate. And, because I mean, who can complain about positive wage growth, particularly real wage growth?
Yeah. What about you, Guy? What's your initial reaction here?
Well, it's a good report. I think that the fact that unemployment rate, for example, fell back to 3.8. I think there's a sort of like, if you were a pessimist, there's been stuff to look at in some of the recent reports. Like, for example, the unemployment rate is up a little bit. Prime working age employment population ratio, which I think was was held steady this month, has fallen a tiny bit since last summer. So the fact that these things are not moving in the same direction, that there isn't sort of this sly deterioration in the household survey this month sort of adds more weight to people that are relative optimists. And that's really it. I think that again, with the wage growth number, I'm somebody who sort of doesn't, that link between wage growth and inflation, I think, is not super strong. I think Chair Powell kind of has the same view. I mean, if wage growth accelerated, that'd be worrisome, but like we're sort of at a range where I don't think this is really necessarily super determinative of where inflation is. So there's still a question mark here of, is it possible, really lucky that, we're seeing supply side expansions in the economy that's going to go on for a while and we see inflation come down. But like, it is also possible that, the 2.5 that Allison described is optimistic. And, we're going to start seeing, January and February aren't that out of whack. And we start drifting back toward 3% as we head toward the end of the year. I think that like, there's sort of this gigantic question mark on whether we are really lucky and we are in Goldilocks, or this is a temporary island and the Fed just starts having to hit harder on the brakes later on. I'm sort of in camp one as an optimist. I'm in a labor market guy, so I always have to hope for the best. But I think that is a genuine risk that could materialize. I don't think we have a lot of clarity. Certainly a lot of pessimists that are saying that's where we're headed.
Yeah, sure. Well, let me give you all a quick market reaction here. I just put this is the yield on the 10-year Treasury note I just put up on the screen. I think you could say that this is sort of a glass half empty knee-jerk reaction from the bond market, which is essentially that it does matter for monetary policy. You see yields moving up intraday, eyeballing it about 7 basis points after the move. That's something meaningful. I mean, on the one hand, this keeps telling us again and again that we're far from recession. But on the other hand, the question becomes, is this an issue for inflation going forward? And to your point, Guy, it seems like Chair Powell himself is willing to be in the glass half full camp. You listen to somebody like an Austin Goolsbee, considered part of the dovish wing of the FOMC, and they too would say, I'm just laser focused on inflation. And I think people are particularly sort of skeptical about thinking about this in a Phillips curve framework because there is still a lot of supply chain healing that's going on. And as Chair Powell himself made the case recently, I want to get into this debate a little bit. It's possible that the labor market pie itself is actually growing, right? Because there are some interesting dynamics going on with immigration itself. And there is a a very lively debate happening as to what the neutral rate of job growth, consistent with stable prices, actually is. Why don't we go there while I pull up the decomposition? What is your take on this immigration debate and the idea that maybe neutral payrolls growth may have, something like doubled from, say, 100,000 to 200,000 something? What is your take on that, Guy?
I mean, I think it's definitely true. I mean, the precise numbers are to be debated, but there's no doubt that, and this there's almost been two steps. I think there was an initial surprise probably in 22 on immigration, aside from a few really savvy people that I wasn't one of, that were paying attention to visa data early on. Like, this was already happening, and it seems like it's taken another step up recently, maybe in a way that the household survey is not doing great. I know it's a hotly contested topic. Maybe the household survey is not doing a great job of keeping track of recently. It's definitely doing it. I think the question comes to my mind as somebody who's an economist who stays at high frequency data, maybe doesn't have super deep insight into either politics or the demographics of source countries, is how long does this continue for? And what happens once it slows down? Is it just simply that, payrolls takes another downshift down and we, the labor market goes on? Do we start looking more like Europe, which has labor shortages despite, very weak demographics? Or, I think there's still it's not so much a focus on what's going on right now. It's certainly interesting and very important. I stare at it, but I'm actually interested in how long can this go on and what happens when it stops? And does that present policy challenges, or do we just smoothly adjust to a world of 50, 100,000 person payrolls a month and tight labor markets? And we're just like, that's what a good number is these days. I don't know. 300,000. If you really believe the strong versions of the supply side story, it's actually a weird world where we're adding this enormous number of jobs. And, the unemployment rate is still up a little bit. Employment population ratio still is down a little bit. So labor market's actually loosened a little bit. And wage growth is moderating, even though we're having these strong numbers. I'm interested in sort of what the steady state looks like after this and when that transition happens.
Sure. Allison, your take on the big immigration debate here? I should point out, some credit to Brookings for really starting this conversation. They were the ones that came out with the paper, and I believe they estimated that the new neutral rate, bearing in mind what we now understand about immigration trends recently, could have moved up to something like between 170 and 230. I hope I'm not misquoting their estimate. But does that sound plausible to you, Allison?
Yeah, it does. I mean, I think, despite everything, we still have a really tight labor market. We saw that in the JOLTS data a couple of days ago, that, it's particularly for like low skill, jobs, it's like those wages are still growing fast. There seems to be a real dearth of people who are willing to and able to do those jobs. So it does seem like, there's a lot of room for more migration. I'm not sure, how that changes. It could be, the only thing that will someday, I don't know when, there will be a recession. I'll put 100% odds on that. And so, I mean, I think that could be the only thing that really changes it, because we're having strong productivity. We're having really strong labor demand. People still keep buying stuff and experiences and are quite willing to spend a lot of money on that. And, it just seems like we're going to keep on keeping on until some shock comes along or something else that takes the wind out of everything's sails.
Yeah, I did put up the decomposition here just to walk people through what's actually driving this 303,000 payrolls gains in the month of March. And I'll just quickly run through it here. I mean, my headline takeaway is, you just can't make excuses for this. It's broad-based jobs growth. You see an acceleration from February to March in mining and logging, construction, manufacturing, which briefly lost jobs on payrolls in February. It moves to flat. Trade, transportation, and utilities down a little bit, but negligible, margin of error kind of stuff. Information basically flat. Education and health services, that's always one I'm really interested in, because it does seem like that's an area where you're just structurally understaffed. It's not necessarily tied to where you are in the economic cycle. So when you see a lot of strength, I often ask myself, well, can I completely just explain it away with the hiring of nurses and this sorts of thing that the healthcare system just really needs, irrespective of the economic cycle? And my answer to myself, just eyeballing this number, is no. I mean, education and health services hiring continues to be relatively strong, but it's not out there on an island. Everything is relatively strong. And the other one, that you maybe put an asterisk next to is government, right? So it continues to be another month of strong government hiring. It actually ticks up a little bit to 71,000 from 63,000. I will, for the sake of this, I'll also put this up as a 3-month net change to smooth a little bit, so people can sort of get an idea of what is moving the needle. But again, I'll underscore that a lot of the raw number comes from that education and health services number. That's the green bar in our decomposition here. But it's absolutely not the only thing, right? You see growth in a lot of categories, and that seems to be consistent with, at the very least, a quote unquote resilient economy. Are you coming to more or less the same conclusions when you look at this decomposition, Guy?
Yeah, I mean, I know there's people that focus sometimes, especially with the job market reports that were strong but not quite as strong. We're like, oh, it's just a few sectors. But especially healthcare and leisure and hospitality, there's these aren't cyclical sectors where you're like, oh, as soon as demand wanes for healthcare, we're going to see this. I think that the question, what would take you to convince you that this economy at risk of recession, is really, you have to think of a shock that basically causes people, even people that have jobs, to cut back on spending, which then creates this feedback loop. You can come up with those theories, but they either are like things that totally surprise us, or inflation starts zooming up so much the Fed says, we have to step more on the brakes. That's not easy. The one sector that I think is sort of, I'm not a naysayer on government jobs. Jobs are jobs, and the government, is understaffed a few years ago. It makes sense for them to add, particularly as other sectors slacken, they can finally get talent. But I do think this is a place where you start worrying about some of the pandemic era boost to government finances, particularly state and local level, starting to fade a little bit. And, at what point do they have trouble? Right now, they're taking advantage of the supply side, or really talent that's not being absorbed by other sectors that are higher paying. But if they start being more crunched in terms of budgets, then will this, engine of the plane start getting a little weaker? And we're not seeing it right now by any means, but I hear enough occasional stories popping up out, I live in California, we're a state, which is a state very dependent on what the stock market's doing in many ways. And again, if state finances and local finances turn, could that get a little weaker? And is that something on the horizon? I mean, it's something I'm thinking about.
Okay. Yeah, like to that point, just because it's Final Four weekend, I was just reading that UConn, happy about sports, but is facing huge across the board job cuts, just because they got a lot of, like a lot of states, a lot of federal money, and that made, state governments really flush. It got passed on to the university, and the university started behaving as if this would be a permanent thing. And now they're realizing it's not. And a lot of, I think that's one of the, I mean, again, you never know what a shock's going to come along and do to the economy, but one potential weakness is state and local finances, which did get pretty pandemic rich. And I still don't think have come to terms with, they were in bad shape going in. Probably maybe got a little dependent on that. So far they've been holding up better than I would have thought, but over the next couple of years, that could be an issue.
Sure, sure. Another bearish story that I hear sometimes that I thought it was interesting. Chair Powell actually mentioned this, I think, in his March 20th press conference. So the hiring rate, if you go by the JOLTS data, has remained pretty low. There was a month in late 2023 where it got very, very low, and just arithmetically, that made some people concerned, because you say, well, if hiring is so low, it wouldn't take very much of an uptick in layoffs for that unemployment rate to start drifting higher. Is that a story that keeps you up at night, Guy?
It would have 6 months ago, but I was looking at it. The hiring rate is down a lot, so is the quits rate, and we're adding about the same number, maybe even slightly higher number of jobs every month than we were before. I think what's really going on, and this may just be the supply side story, is, supply is coming in. It's allowing people to keep adding jobs, but the part of hiring and quits just involve people having lots of opportunities and lots of churn, so that for the same role, you just have to hire a bunch of people, or more frequently, that part's faded. So we can have simultaneously lower hiring, lower quits, and similar or even slightly higher employment growth. So I'm not worried about it. Certainly if it kept falling, that would be worrisome to me. But I think it's just, this is an economy that right now is probably very flush with labor supply. And so as a result, despite the fact we're adding a lot of jobs, employers have more bargaining power. People are quitting less because supply means they're competing for jobs with more people than they were a year ago. It's not bad, but it's not great. And I think it's an unusual environment in that respect. And I think that's sort of how I've come to terms with it. I think the question is, can it keep going down? At a certain point, does it get worrisome? At some point, do we worry this is like this is like way premature. It's like a eurosclerosis type situation where, if you have a job, you're sitting pretty. And if you don't have a job, you're really big. I talk to some of my friends in the tech sector, and like for them, it is a hard job market. I mean, it's an unusual sector. It's anomalous, but I think that is, I think that there's a question of people that are insiders and outsiders. I think it's way too early to say that. But right now, I just look at it, I've kind of come to terms with the lower hiring rate. We're in a phase where hiring is just low, and it may just be supply side kind of keeping churn down. People taking jobs and not leaving them. But I'm not worried about it right now. Not in the way that I was maybe 6 months ago.
That's interesting. So you mentioned anecdotally people in the tech sector. One thing that I did think was very interesting about the hiring rates, I looked at it on a sector by sector basis, and I said, like taking a Z-score from what I think was normal, like 2015 to 2019, what sectors are actually seeing hiring that it's so low that it's out of the ordinary? And it really seems to be the white collar spaces, financial activities, professional and business services. Are we, Allison, do you think we're in some sort of dual track economy where outcomes are different for different sectors, and maybe the white collar space is a little weaker than others?
It could be, or it could just be that it eventually trickles down to other parts of the economy. I think it depends on, on how things evolve. I mean, to some extent, it could be the result of higher interest rates are really hitting those sectors. Like, for instance, in tech, they're just not, they were arguably, when rates were effectively zero, maybe a little had too much money like going their way. So they weren't particularly sensitive and could grow a little bit maybe faster than they should have. And maybe they're adapting to a new environment. Obviously, finance is very sensitive to interest rates. So, I mean, the question is does this higher rate environment eventually sort of hit other companies too and really sort of impede their ability to get capital? Or is this or do we just have two sectors that really became very dependent on a zero rate environment, and that environment's gone. And while the rest of the economy can handle it, they can. And I actually don't know which one it is right now. I guess we'll find out.
Okay. I have one more bearish scenario to throw out to you two, and it concerns asset prices, right? Because obviously the U.S. stock market has been absolutely on fire. Home prices were on fire. They've sort of flattened out, but a lot of people have a lot of home equity. And you could say that all of this has been part of a virtuous cycle, right? It at least, you know, the part of the American population that is lucky enough to own stocks and owns a home, they've been feeling pretty good about themselves for the past, you know, call it 6 months, 18 months, or something like that. And it feeds this virtuous cycle, right? I mean, people can argue about you know, how many marginal dollars it actually increases consumption, but it makes Americans feel good about themselves. They go out and they spend. That translates into company earnings, and then stocks keep going up, right? And so the question is, and I'm asking this now because you know, there was the market got spooked late yesterday, took a big dive. I don't know if it means anything. Maybe it's just normal volatility. But if it were to mean something, if the market were suddenly to turn for fundamental reasons or non-fundamental reasons, could it turn this virtuous cycle into sort of a deleterious cycle that goes south on us relatively quickly? What do you think, Guy?
I mean, it could. I mean, I would never be dismissive of it, and if it's big enough, then certainly it would. But what gives me a little pause about being too pessimistic about this is, you know, we've seen this big run up. We've seen, you know, if you think about financial conditions, that, you know, there are lots of indices out there, but they all show there's been easing as the, you know, asset prices go up, as the market anticipates the Fed cutting to some degree next year. Maybe that's fading a little bit with the data we're getting. And things like hire, I mean, yes, we're adding a lot of jobs, but it doesn't really, you know, employers aren't like suddenly ramping up hiring plans. We do not, they're still pretty cautious. We still, you know, if you look at, for example, the core capital goods orders, which again, maybe are becoming less relevant with you know, CapEx being more intangible, but it's not ramping up. It doesn't look like businesses are acting as if this is an environment where, you know, they're really getting a lot of leeway. They're not really taking advantage of you know, these asset prices to significantly expand their operations. So I guess I sort of think about, to what degree, how far would have to swing the other way to push them off this path. And it might have to be, I mean, again, I don't know what a lot is, but if they didn't respond that much on the way up, how much are they going to respond on the way down? And I guess that's sort of it, is maybe it would have to be pretty substantial for it to meaningfully knock this situation off course.
Okay. Allison, what about you? I mean, you're an expert in risk, right? You wrote the book, and you know, you've recently done some writing for Bloomberg Opinion about gambling. A lot of people are doing it in this economy. You know, what happens when you know, these sort of attitudes that, you know, prompt us to spend thousands of dollars on DraftKings and pile into Bitcoin ETFs? What happens when that goes the other way?
Well, as I said, like, I mean, there's certain exuberance to the economy. Otherwise, Guy says, I don't think it's insane. I mean, I think it's worth noting that, like, a vulnerability I see is you do see consumers start to have a lot more debt. Although this is largely, I'd say, the bottom 50% who tend not to be as asset rich. So I'm not sure if the stock market sentiment maybe impacts them, but if the stock market going down wouldn't have as big an impact on them, because if they own stocks, it's probably more in a 401k plan than in like a personal brokerage account. But so they would be the ones that'd be most worried. But again, like, you know, animal spirits, like, you know, are a tricky thing. And you know, I'm more concerned about an exogenous shock that I really cannot imagine right now. That's usually, I can never predict recessions, but I think you can look for vulnerabilities and see how resilient you are. And I think we're not mildly, a fair bit less resilient than we were a year or two ago, just because household balance sheets aren't quite as healthy. But so, I mean, I have no idea what if I think we're going to be a recession, I'd call it from something we don't anticipate right now, some exogenous shock. But by definition, we don't know what that's going to be.
All right. Well,
She nailed it.
Absolutely, and I'm gonna leave that as the last word as we wrap up here. Thank you very much to Guy Berger and Allison Schrager for being with us. Thank you to everybody who tuned in. Your last minute market check has your 10-year yield at 4.39%. So a meaningful jump off the back of this non-farms payroll number. Everybody enjoy your Jobs Friday and best for the weekend. Thank you for joining us.